Hello, I'm Adam Grimes and welcome back to the Interactive Brokers Introduction to Technical Analysis course. Here in Unit 6, we're going to talk about volatility. What is volatility? How do we measure volatility? And why do we care about volatility? Volatility is a little bit different than many other aspects of the market. We can see patterns, we can see volume, we can see movements between price levels, but volatility is hidden. Volatility must be calculated. So anytime we talk about volatility, you need to be aware that we are talking about both whatever actual volatility might be in the market, but also the specific way that we have chosen to measure volatility. And this is important because anytime we discuss volatility, we are discussing a calculation or a measure of volatility. So what is volatility? Well, here's an academic definition. Volatility is a measure of risk, and a very common way to calculate volatility is the standard deviation of returns. And you might remember returns are just the percent changes. So you take, for instance, the day-to-day percent changes, calculate the standard deviation of those over some time window. A more practical definition of volatility is it's just how much a market moves around. And you can imagine that we might have two categories, a market that's very flat and dull, and then a market that moves from one price level to another. But within that, we also might have some subtlety, right? The market that moves from one price level to the other, how does it do that? Does it do it in a straight line? Does it do it by moving through levels? Does it do it with a lot of back and forth? There's a lot of different ways. Even if a market is moving from point A to point B, there are a lot of different ways that we could get there. And how about this for a definition of volatility? How much something is likely to move around in the future? This is probably what we really care about in many cases. Anytime we're measuring volatility, we're looking at the past, but we're hoping that a relevant measure might tell us something about the future. And like all of this work, we need to understand that this only exists within the bounds of probability. The better you understand the tool, the better you understand the way you measure volatility, the better you might understand what implications it might have for the future. So I'll show you here in Trader Workstation. Here's where you can find the volatility studies, ad study, volatility study, and then you have a number of those that you can apply to the chart and play with and see what they will show you as you change different parameters. Let's look at some specific ways to measure volatility. Historical volatility. This is basically that academic definition that I mentioned, standard deviation of returns. It's usually annualized. So you get a percent number that would apply to price movement over the coming year. Another common way to measure volatility is average true range. What is true range? Average range is easy to understand. Range is easy. If you have a price bar or candle, you have a high and you have a low, and the range you can see is just the difference in between the high and the low. So if you average that measure over a time window, 9 or 20 are common numbers that are used for the time window, you'll get an average range for 9 bars or 20 bars. True range adds the overnight move from the previous close. And the thinking is that, let's say you had a price bar the previous day that closed here, and then the current day opened here, so you had an overnight gap. And of course there are other configurations we could look at. True range would say, wait a minute, even though the high of the bar is here, the market really did cover this distance. Maybe it did it in an overnight gap, maybe it did it in another session. For instance, a futures market that might trade more or less 24 hours. Maybe the day session opens here, but really it did trade here overnight. So this is what true range is. It adds the overnight move from the gap, and this is commonly used. You'll see average true range. It's one of the most common measures of volatility used in technical analysis. There are all kinds of other ways to measure. One that I use is called sigma spikes, and this looks at each day's move as a standard deviation of a previous time window. So it's a way to say, is the current price bar. Is this move a big move or an insignificant move? It's also implied volatility. This is a word that option traders are very familiar with, and this must be calculated, backed out effectively from observed options prices. And if you don't trade options, that probably didn't make much sense to you, but if you do trade options, that's something you'll need to have a pretty good understanding of at some point in the future. And there are a lot of academic models, different ways to measure. You can use opens, you can use many of the measures just use close. A lot of different ways to model and think about volatility. Now, why do we care? Well, volatility has some characteristics, and one of the common things that we see with volatility is that volatile periods tend to cluster together. This is a very strange chart on your screen. Let me just orient you. You can find the blog post here. The URL is at the bottom. Each of these lines is a separate market. The S&P on top, currency, stock on the bottom, and a futures market in the middle. And this is a measure that filters out the small moves and just shows us the big moves in absolute value. So whether the market went up or down, you're going to see a positive number here. And notice that, of course, nothing works with perfect regularity, but we do see a disproportionate number of cases where volatile periods cluster together. And you will also see the opposite of this, where markets are quiet for a long period of time, and that's the absence of volatility. But then when it comes in, we tend to see clustering. By the way, here's something that's kind of fun. When you're thinking about these things in the abstract, it's good to think about what might actually be going on driving this in the real world. And one of the things that we see with stocks quite frequently is about 4 big volatile spikes a year. Why? Earnings. Because stocks report quarterly, so it's normal. Many stocks will show volatile moves on those earning releases, and you can see here jumps right out at a volatility chart. On a volatility chart, might not jump out quite so much on a price chart. These are, by the way, sigma spikes. If you want to know more about that, you can Google sigma spike and you'll find I've written quite a lot on the topic. Another thing that is important is volatility compression. And the way we think about this, if we measure volatility over a short time window and look at it relative to a longer time window, so the market, the way to think about this is when that shorter term volatility becomes very low relative to the longer term average. Another way to think about it is the market is quiet right now relative to how it usually moves. We can say this market is in volatility compression. And when a market is in volatility compression, we tend to see that big moves will continue. And I know this is a chart here with a lot of numbers, but this is a measure of breakouts out of volatility compression in stocks, and I would just call your attention to the statistical significance indicators, the asterisks. That just shows you that there is a statistical edge to trading around volatility compression. And again, if you want to know more about it, here's a URL where I took this chart from my blog. Let's touch very quickly on implied volatility. Options are priced according to different price models that will typically use these 5 factors: the price of the underlying, whether it's a stock, future, currency, strike price of the option, how much time is left in the option, and then there are these others that really usually don't matter very much: interest rates, changes in interest rates, dividends. They might matter sometimes, right? But then there's this volatility. Everything we see here, every one of those things that I listed, we can measure. We know what the price is. We know how much time is left. But volatility is the one that is not concrete. To measure volatility, we have to use some calculation. I've shown you a bunch of different ways to do it. But if we look at the options market, you will see the options market gives us a price for an option, and then we can kind of run the model backwards and figure out what volatility is being used to justify those prices. That is what implied volatility is. Another way to think about it is that it's a measure of whether options are cheap or expensive. And if we see in a relatively quiet market that options become expensive meaning the implied volatility would go up. That would tell us that the options market might be anticipating or expecting some big move. It's good information to have. And you can see this typically ahead of earnings for a company, crop report, sometimes ahead of major anticipated political or economic events. And just realize that it's a warning that the market might have some expectations. We also talked about academic models. We don't have time to go into those in a lot of depth because a lot of these are quite complex. People build careers around volatility modeling, and the core ideas in most of these models, though the models are complex, the core ideas are quite simple. And these ideas are that volatility tends to have a long-term average level, and volatility tends to come back to that long-term average level in the longer term. In the short term, your best prediction of future volatility from a modeling perspective is recent volatility. So if you have a market that is currently extremely volatile, your best expectation is that that volatility is going to continue in the short term, and you can play that off against the longer term tendency. Volatility shocks tend to fade away. There are models that are built around only this concept, and you might think about walking up to a quiet pond or a lake, throwing a big rock in, you get a big splash, and then the ripples kind of fade away. That's how these models tend to see volatile shocks in markets. Timing of arrival of these volatility shocks is unpredictable because it's usually driven by news. Now that's a lot, and again, for some of you that may be very relevant, but if you don't think it's relevant to your style of trading, I would encourage you just to take a moment, look at this slide, rethink how it might apply to you, because it probably does. And whether you realize it explicitly or not, in terms of the types of risk that you're taking and some of the expectations you can have from your markets, understanding volatility better will give you a deeper understanding both of the market and your trading. Quick summary. Volatility must be calculated from prices, cannot be directly observed. There are many different ways to measure and calculate volatility. You need to understand how volatility might be relevant to your style of trading and understand how the way you measure volatility might shape your perspective on volatility. Thank you very much.